Rental properties. You've probably rented an apartment at some point in your life. Maybe you own some or you have owned some. Maybe you thought about acquiring some. Maybe you think renting forever is the best way to manage the roof that you need over your head. Maybe you think landlords are the scum of the earth, sitting back, cashing checks, and getting rich off the backs of the working class. Maybe you think tenants are the scum of the earth, gaming the system however they can, and are ultimately a larger liability than they're worth. My name's Johnny Wagner. I'm a real estate agent in Buffalo and all of Western New York. I've worked with clients to buy, sell, rent, and manage rental properties since 2016. I've helped clients identify and obtain properties that make them a lot of money. I've found and placed stellar tenants, and I've opened the doors for the U.S. Marshals to carry out evictions for not-so-stellar tenants. I've seen the good, the bad, and the ugly, and I'd like to share with you some of my notes and offer a perspective that perhaps you've never considered. Today, we're going to be talking specifically about residential rental property. Commercial's a whole different animal. When you get to a certain size, it's a different class. Today, we're talking about residential stuff. I just want to note, I'm not giving you financial advice and I'm not giving you mortgage advice. There are people that are much more qualified than me to give you that advice, and those factors obviously play big roles in this conversation. If you need further information on those factors and don't know where to start, I have plenty of people I can put you in touch with. I'm a real person that you can really reach out to, and I will respond. Having a roof over your head is something that we all need, and it's going to cost money. The math for the monthly cost works pretty similarly whether you rent or own. Probably some type of mortgage, property taxes, insurance, utilities, maintenance, and repairs. If you buy a house and you handle those things yourself, you're a homeowner. If you own your house with a fixed mortgage payment, you're in more control of the cost, but you don't have the flexibility of renting. For your efforts, you're usually rewarded with equity. If you rent, you outsource most or all of those things, and you're a tenant. You're charged a fee that covers those costs in exchange for use of the space. You could pick up and go on relatively short notice. Most of the work is handled. Many of the big costs like appliances, furnaces, and the roof aren't coming out of your pocket as soon as they break, but you sacrifice big equity and financial benefits. The amount of rent you're charged can be just as flexible, but often upward. And if the building starts breaking and it costs the landlord a lot of money, usually it's only a matter of time before that cost is passed down to the tenants. Good landlords increase the rent to be ready for big capital expenses, keeping rent as stable as they can. There's good arguments for both. Everyone's situation is different, and I'm not here today to argue in either direction, but I am a genuine advocate of home ownership. If you own the space and you rent it out, you're a landlord. If managed properly, you can enjoy the equity and cash flow, but first you have to stabilize and manage those properties. No doubt, there are bad landlords out there. The type that never fixes anything, sucks as much cash out of the building and the tenants as they can, lets the property fall to pieces, and seemingly gets away scot-free. They're terrible, and like many things in life, some bad apples give the bunch a bad reputation. But that doesn't mean the good ones aren't out there. The ones that run stable and well-managed buildings, prioritizing the needs of their customer, which is the tenant, running as efficiently as they can to keep rent as low as they can and still make a profit so that it's worth their time. Generally, when you're thinking about someone that owns property just so they can sit back and collect checks, you're thinking about the former. If you're looking for space to rent, finding the latter may be easier than you think if you know how to look. If you're looking to become the latter, boy are you in the right place, and I'd love to chat. All rental property is basic income and expenses. If you own a building and you rent the space out, you subtract the cost of owning it and hopefully there's cash left over. That's called a return, and that's how most people evaluate investment property. Either looking at what it costs and produces currently, what it could cost and produce, or some combination of the two. Those costs will include things like property taxes, insurance, usually at least some of the utilities, and sometimes things like lawn care and snow removal, especially here in Buffalo. It's also wise to set some money aside for things like maintenance and vacancy, and if you're hiring a property manager, their base fee is usually a percentage of the gross rent. We'll talk about property managers shortly. Back in the day, property didn't appreciate as quickly and exponentially as it has over the past few years, so everybody was looking at cash flow. Hypothetically, I pay $100,000 cash for a 2-unit apartment building. Each apartment has tenants that are paying $750 per month each, which works out to $18,000 gross rent per year. I subtract $2,500 in property taxes, set aside $3,600 or 20% of the gross for maintenance, repairs, and vacancy. I pay the water bill, which is about $900 a year. I pay $2,000 a year for property insurance, and I manage it myself. That means it spins off $9,000 a year in cash flow or a 9% annual return. I'm a happy camper. That's an oversimplified look at things. Of course, any one of those things could not work out as planned. A tenant trashes the place, which carries both construction costs and lost rent. The main water line coming in from the street needs to be replaced, costing you more than the $3,600 you set aside. Costs. You get the idea. It can unravel pretty quickly. But that risk is what makes way for a return, and knowledge can mitigate risk. Fast forward a few years, property and buildings have appreciated, and now it's worth $130,000. So now it's cash flowing, and I can sell it for a profit. Or I can borrow against that equity. Another hypothetical for you. You want to buy a 2-unit apartment building, and you make an offer that allows for a cash flow return that you're comfortable with. But someone else comes in at a much higher purchase price than you, not leaving any room for cash flow at all. And that leaves you perplexed. The buyer that bought it is banking on appreciation. Some time goes by. Rents go up 20%, causing the property to further appreciate. You still want to buy that same building, so you approach the owner. Not only will the owner get the benefit of the appreciating value, but because the rents have gone up, it now also cash flows. That owner, who beat you the first time when you tried to buy it, is winning in a big way, but they had to take massive risk to get there. Begrudgingly, you agree to buy it, and for a number that doesn't cash flow. Now, you are also banking on appreciation. As soon as you do, you start looking for tenants that'll pay more, but you can't find them. And because you can't find them, its value stagnates. So now, you own a building that doesn't cash flow, will absolutely break in very expensive ways that you'll have to fix out of pocket, and you're losing money. Your options there are to sell at a loss, ride the wave until rents and values go up, or you could be a crappy landlord by not fixing anything, letting it go to upsetting your tenants, who then leave. Then you have to find new tenants, but the apartment is worse than it was, so you don't get as much rent for it. The only way to fix that is to inject more cash into the place. But I thought this landlord thing was supposed to be easy. You just own a building, sit back, and collect checks. In order for that to be the case, you have to buy something that cash flows a lot, but those are hard to find. Because if it cash flows that well, why wouldn't the property owner just keep it? In place of that, you can speculate and take that risk. Some people do that well, a lot of people do that poorly. I see that every day. Especially in these Instagram gurus that make all their money charging you for their course on how to get rich off of Section 8 housing, or get rich off of Airbnbs, or get rich off of their already existing real estate syndication portfolio. Those people are usually excellent marketers and terrible real estate investors, and they are very gross. And of course, the mortgage. Financing an investment property usually carries much different terms than getting a mortgage for a property that you're going to live in. And by different, I mean more costly. When people talk about mortgage interest rates, they're generally talking about rates for property that are occupied by the owner. If you get a mortgage for an investment property, the rate is almost always higher than that. Usually at least 1% higher, often several percent higher. Adjustable rates are more prevalent. Down payments are higher, usually at least 20-25%. Fees can be higher. The amortization, or the length of the loan and how the payments are broken down, can be shorter, making payments higher. You get the idea. It's a different animal. If cash flow is the most important thing to you when you're buying rental property, owning it outright is the way to go. And I realize we're talking about several $100,000 clips here, which is not easy. But when you pay cash to buy an investment property, you're paying yourself the interest instead of giving it to the bank. These days, that interest rate is pretty high. Remove the owner occupancy for a moment. We'll talk about house hacking shortly, but let's assume you're financing a property as an investor. And for easy math, let's say you buy a $100,000 house with 20% down and an 8% interest rate. In the first 3 years, if you make only the minimum payments, you'll be paying over $18,500 in interest to the bank. I'm making some gross generalizations here. Every situation is different. A friend of mine just bought a double in the city of Buffalo as an investment with 10% down, and the math works. There's also creative mortgage products. There's a program called a DSCR loan. DSCR is a type of mortgage specifically designed for real estate investors who are buying or refinancing income-generating properties. It stands for debt service coverage ratio, and it focuses on the property's potential to generate enough rental income to cover the fixed expenses of the property. Instead of evaluating the borrower's personal income and employment history like a traditional mortgage, DSCR loans primarily look at the property's cash flow potential. Lenders calculate the DSCR by dividing the property's net operating income by its total costs, or what it's going to cost you to own the place. If there's money left over after you've paid all the expenses, the bank is happy to loan you money for property without looking too deep into your personal financial profile. They will, of course, be charging you a premium for that convenience. Sometimes you'll find a seller that's willing to sell you a property and act as the bank. This is called seller financing or owner hold. They usually like a large chunk of money down and a nice juicy interest rate for them, but it may be worth it to you as the buyer to not have to go through the underwriting and pay lots of fees to the bank like you would with a regular mortgage. I love seller finance deals. As you can tell, financing options vary as much as the properties themselves, and I've barely scratched the surface here. If you're interested in exploring these options further, reach out to me and I'll put you in touch with the right people. Throughout this video, I've spoken about property that you own strictly as an investment and how that compares to when somebody buys a house to live in. But what if you can have both? You can, and some buzzwords for that are house hacking, or more recently, accessory dwelling unit. Maybe you've heard of it, maybe you know people that have done it, and I love this idea, especially for somebody's first purchase. Basically, you go buy a 2 to 4 unit property, you live in one of those units, and you rent the rest out. If you're getting a mortgage to do so, you get a lot of the benefits of owner occupancy, like lower down payments, lower interest rates, etc. In a good deal, the rent the building generates covers most or all of the monthly payment of the mortgage, and you live for pretty cheap. A large portion of the rents that it generates counts as income in underwriting, so you can get a higher loan amount. If you end up buying a different property later, you can keep this first one, rent out the unit that you were occupying, and you own an investment property for about as little out of pocket as you can get. But there are, of course, downsides. You bought a house, but you live in an apartment. A 2-unit is basically 2 houses inside of one building. So you're maintaining 2 kitchens, 2 bathrooms, 2 electric panels, 2 furnaces, double the amount of windows, you name it. And if all the tenants leave, you're still on the hook for the whole monthly payment, which can put you in a tight spot. It's not perfect, but I've seen quite a few people leverage this strategy and win. All occupied properties have some sort of manager. They're doing things like finding and placing tenants, collecting rent, striking a balance between rent rates and occupancy, handling maintenance and repairs, working through evictions, and so many other things. This is true of regular houses too. When you mow your lawn at your house, you're managing the property. Some do it better than others. Lots of people self-manage, meaning they're the owner and the operator. Some property owners outsource that responsibility to a professional property manager, usually for a flat fee or a percentage of the gross rent. Those property managers are also usually going to charge you fees like onboarding fees, leasing fees, and other things. Not only are they taking responsibility off your hands, but they can bring vast experience and resources to the table that you wouldn't otherwise have. Things like full-time staff, avenues for tenants reaching out for maintenance and repairs 24/7, processes for accounting and rent collection, marketing of vacant units, you name it. And again, some are better than others. In general, whether you're doing it yourself or farming it out, good property management makes or breaks a property. And of course, I have plenty of property managers I can refer you to should you need one. I'm not trying to sell you anything, I'm trying to give you something for free, so please don't double tap the fast forward. Over the years of doing this, I've noticed lots of small things that don't take that much time or money that you can do that will save you a lot of time or money later. And I've put together a free checklist that I would love to send to you. Send me an email or send me a DM on Instagram with the word checklist, and I will send it to you completely for free. And rental assistance. Sometimes the rent a tenant pays is subsidized, and this is often called rental assistance, often referred to as Section 8 and facilitated by local organizations. Here in Western New York, the ones I most often work with are Belmont Housing Resources and Buffalo Municipal Housing Authority. Sometimes those local organizations own and manage entire complexes exclusively for subsidized tenants. Sometimes they offer subsidization to tenants who are tasked with going and finding their own private landlord and being subsidized that way. In order for the property to qualify for rental assistance, it's usually subject to some type of inspection by the facilitating organization. They're looking for pretty standard quality of life stuff. GFCIs by any water source, appliances that work, windows that open, smoke and CO detectors that are in the appropriate places. I find a lot of people that think these requirements are a lot more stringent than they really are. Basically, if you're running a good property, you should have no problem passing this inspection. This is important, and if you only take one thing out of this video, I want you to take this one. Here in New York State, there are laws that prohibit discrimination based on a tenant's lawful source of income, and rental assistance is lawful income. You should consult an attorney because I am not one. But I'm always astounded at how often I hear, I don't take Section 8 from a landlord, because they could be putting themselves in seriously hot water with that statement. Now, property types. There's some big distinctions between how many units a property has and how it works as an investment property. I mostly deal in 2 to 4 unit buildings. Single buildings or parcels that have 2 to 4 living units within them. These are considered residential, both in terms of financing and regulation. It's easiest to get a normal mortgage on this type of property compared to the others. House hacking applies here. You'll find them in areas that are zoned residential, etc., etc. I'm not saying it's the best way to do it in general, but I would argue it's the best place for most people to start. Some people buy single-family houses to rent out, and there's pros and cons to that. Some of the pros are, tenants are likely to pay a premium to rent a property that they don't have to share with other people. I find they stay longer, they're more likely to treat it as their own, but certainly not always. Maintaining and repairing a single unit can be easier and cheaper than multiple units, you name it. One of the cons is that occupancy is like an on-off switch. If you own a double and one of the tenants leaves, you're still getting rent from the other tenant. If your tenant in a single-family house leaves, there is no rental income until you find a new tenant. And finding that new tenant can take longer because you're usually charging more than a regular apartment, which limits your tenant pool. And finally, single-family home values have a lot more to do with what other people are paying for similar properties than they do what kind of income the property can generate. This could be a pro or a con when it comes time to sell, depending on what the local market's doing. Anything with 5 or more units is considered commercial, which again carries financing and regulation considerations. Let's say you want to own 8 apartments and your options are to buy one building with 8 units inside of it or 4 duplexes. I could argue for both. Having one 8-unit building means you only have one roof to replace when the time comes. Having 4 duplexes means replacing 4 roofs. If you're going the 4 duplex route, each apartment and each duplex is going to have its own heating unit, which means at any time, any one of your 8 furnaces could malfunction. But it's easier to pass that energy bill to the individual tenant. If you have the one 8-unit building, it's going to have one big-ass heating unit, which is less likely to break as often as 8 furnaces, but will be more expensive when it does. Plus, when you're using one heating unit to heat 8 apartments, it's more difficult to charge each individual tenant for the energy that they're using. You're usually just baking it into the monthly rent. You see where I'm going here. Once again, every situation is different. Another thing that I see people come across is wondering why rents can vary so greatly within a specific area. Let's say you're a prospective tenant looking to live within a certain area and you pull up the listings. You see some apartments that cost a lot more than the others. This, of course, has a lot to do with specific location, condition, and amenities. Sometimes you find an apartment that checks all of those boxes, but is cheaper than the others. What happened there? Pretty often, I come across landlords that don't raise rents after their expenses are covered. This is usually the case in smaller scale landlords. In exchange, they don't update the properties, and they're happy to have tenants that are fine with that. They're leaving a lot of money on the table by doing this, both from appreciation and cash flow perspectives. But if you're a tenant paying $750 a month for an apartment in an area that routinely gets $2,000 a month, you're benefiting from their mistake, but you're also on borrowed time. Eventually, they're likely to sell. And when they do, you can bet whoever buys it is going to need more than $750 per month to justify the price they just paid to acquire that property. If you are one of those tenants, and you love the apartment you live in, especially for what it costs, my advice to you is to pretend like you have to pay market rent and save the difference. This will get you used to paying what it costs to live in the area that you live, and it builds savings for when the circumstances around that great apartment that's cheap does change. Odds are they're going to change sooner or later. Now I'd like to touch on some questions that I get all the time. Starting with, can I buy a condo and rent it out? I like the idea of buying a condo and renting it out because you pretty much already have property management in place by way of the HOA. The quick answer is it's going to depend based on that HOA's regulations. Some HOAs say, no, you can't rent them out at all. Some HOAs say, yes, you can rent them out, but you have to do at least 6 months or 1 year terms. You can't do short-term rentals. There are some HOAs that say, yes, you can rent it out, but we only allow a certain amount of units to be rented out. And when that's the case, they usually are pretty full and there's some sort of waiting list for that sort of thing. So yeah, if you can find a condo that will let you rent it out, it is nice that you have the management baked into it. Let's say I'm a landlord and I want to increase the rent for the apartments that I'm renting out to people. Is there a limit to the amount in which I can raise those rents? The short answer is no. There are very rarely, especially here in Western New York, I actually don't know of any off the top of my head, but there is what's called rent stabilization. That you see that a lot in like New York City and that sort of thing. But basically, those landlords are not allowed to raise the rent more than a certain percentage, or sometimes even at all. But if you realize that you've been charging significantly less than what you should have been this whole time, you can increase the rent to market. You just have to realize that that tenant probably isn't prepared for their cost of living to go up that much. And if they're a great tenant, you might not want to lose them. What about short-term rentals? Short-term rentals are interesting. I see all kinds of there's all kinds of ways to do that. Obviously, there's the Airbnbs of the world, student housing, furnished rentals for professionals, you name it. There's all kinds out there. I am personally a little bit more bearish on short-term compared to long-term. I know plenty of people that kill with Airbnb, and that makes sense to me because if you're charging by the day or by the week, you can usually yield more per month than you would by doing it long-term if you can keep it occupied. I think something that people don't think about is the so much more management coming with it. Like if you're turning over the unit between each Airbnb guest, you're talking about housekeeping and maybe some maintenance and that sort of thing. And if you have to do that 2, 3, 4 times a month, whether you're outsourcing that, that's going to be costly, or if you're doing it yourself, it's going to be very time consuming. All that's to say, I generally prefer long-term rentals to short-term rentals, but you will have no problem finding people with a different opinion on that. And finally, some quick, easy tips for existing landlords or for people that are thinking of becoming a landlord. So, tenants lock themselves out. It happens. And in order to keep a good relationship with the tenant, you want to be pretty accommodating to them. It blows my mind that I don't see keypads on every door of every apartment building that I ever go in. That is the easy. Tenants are going to lose keys. It's going to happen. If you have the keypad, it is not that hard to change the code for each tenant that you place in there. Having them on the exterior doors and the interior doors is going to save you from having to go out the property at a weird time to let them in, having to call a locksmith and paying for that, or doing neither of those things and having your tenant either be very upset with you or break a window to get in. Furnace filters. Now, there's many different types of heating units. There's boilers, there's these new mini split systems, you name it. But like a traditional forced air furnace, I'm always astonished at how often I go into these places, whether it's somebody's house or an apartment building, that they're either not changing the furnace filters regularly or they don't have furnace filters at all. I'm not an HVAC tech, but I can tell you with certainty that they're like $4, maybe like $10 a piece, and you swap them out once every 2 to 3 months, and that's keeping all the stuff out of your furnace. And much like anything else in life, when you maintain things better, they last longer and you get better return for the investment that you made. It's also a good reason for you to check in at the property. If you tell the tenants once every 3 months, I'm going to come by and I'm going to replace the furnace filter and make sure everything's going smooth, and I would love it if you let me come in and take a look at the place and see anything that you're not seeing so that we can prevent bigger problems in the future, they're usually very open to that. It's like I said, it amazes me how many people forget this furnace filter thing, and it ultimately ends up costing them thousands of dollars. And finally, central air conditioning is an amenity that I'm amazed how often I don't see. Obviously, people want it, and maybe obviously people are willing to pay a premium for it. The other thing that I think is so interesting about central air conditioning is it has its own big electric line run out to the AC system. And if you have tenants that are plugging in those massive window units, yeah, they're probably the one paying the bill, but you're running a ton of power through those wires. There's fire risk there. There's all kinds of things that can happen. Like essentially, unless you're on like the really, really, really cheap end of things, it just amazes me how many apartments I see that don't have central air conditioning and therefore aren't capitalizing on all of the profit potential that they could. I mean, I replaced my entire forced air central air conditioning system, I think like 2 or 3 years ago. It was like $5,000. That's not a small amount of money, but over time, you're going to be able to charge a premium and get that money back, and it should last longer than it takes to recuperate that cost. So that was a lot. I'm making this video because there's so many misconceptions about there about what it means to be a landlord. And I know all kinds of people that come to me and say, I want to buy investment property. And they don't know about any of the things that we talked about here today, which is not a bad thing. I mean, you can't really know that unless you hear it from somebody or go through it and learn the hard way. If you are interested in acquiring rental property, if you own rental property and you want to grow that or maybe even shrink it down, I want to be your guy. The best way to get a hold of me is by email. It'll be on the screen here. You can also hit me up on Instagram. And I look forward to chatting.